So the statement of cash flow is something that you really haven't had much practice at. It's just mentioned very early on in financial accounting, and it's sort of left there for you. So today we're going to be doing a deep dive. Learning Objective 1 takes a look at the statement of cash flow and its parts. Learning Objective 2 is where the work's going to be, because you're going to be preparing the statement of cash flow. And so that's probably the first financial statement you're going to be preparing in some time. When we see each other next time, we'll wrap that up and do some analysis. So that's our goal today. Learning Objective 1, again, the cash flow statement. It's one of the more important financial statements. The difference as to why it's not really kind of talked about early on is, remember, in financial accounting, you're learning generally accepted accounting principles. And so your income statement, your balance sheet, everything that you've learned is based on GAAP. The statement of cash flow is not based on the accrual basis of accounting. It's not based on what GAAP requires. It's actually based on the cash basis, which is not allowed for in GAAP for financial reporting. However, that's what makes this a very curious statement, and that's going to be the part of the statement that you're going to learn today that's going to cause you to scratch your head a little bit. But just know we're going through a process here. It's one of the more important statements. All it does is follow cash. When we say cash flow, we're basically talking in or out. That's really the cash flow here. So let's take a look at one of the more important types of things here. The activities that you learned way back in financial accounting are coming back to you here. Okay. First, your operating activities. It really has to do with your income statement. So operating, remember the hours of operation, what's happening during the hours of operation of the business. Well, your store is open, or your company is open. You're serving customers, so you're collecting revenue, you're paying bills, you're dealing with inventory and other types of stuff like that. Overwhelmingly, operating activities are going to show up as income statement items. And this is the first thing that a cash flow statement talks about, the operating activities. Cash used and cash provided, coming in and out. The next thing a cash flow statement will tell you about is the company's investing activities, and very specifically, the investing activities that we're really paying attention to is investments in property, plant, and equipment. We want to see that a company is, in essence, willing to grow. And the way you grow is by increasing your sales and getting more customers, right? So you usually do that by putting up more stores or doing other types of things that are property, plant, and equipment based. However, investing activities can also be traditional way people look at investing, as I purchased, stocks or something like this. So that can happen, but the most important part, I would say, is the property, plant, and equipment. The third thing the cash flow statement tells you about is about the financing activities. Financing activities is really the other side of the balance sheet, liabilities and stockholders' equity. So remember, the word financing is about where you get money. Okay, to finance something means you need to get money together to buy something. So a financing activity has everything to do with where companies get money. And companies get money two ways. They either borrow money and use that money to buy things, or they ask investors, the owners, to put money in. Okay, that's where it's going here. So those three things are looked at in detail. So let's look at them in more detail. So operating activities have to do overwhelmingly with income statement items, revenue and expenses is what you should be thinking about. If it's related to revenues, expenses, it's probably going to be an operating activity. Again, cash flow looks at cash coming in or staying in or cash going out. Okay. And so for the most part here, the most common way we look at cash flowing in is from selling goods and services. That's the biggest source of cash coming in, as you're selling goods or services to clients and they're paying you cash for that. So that is the biggest cash flow coming in, is your customers are giving you cash to pay for your products and services. But a company can also get cash by receiving interest and dividends, and that cash is also coming in. Cash outflows usually are related to expenses. So when you buy inventory, that cost of inventory is cash moving out of the company to buy inventory. What happens after you sell inventory becomes cost of goods sold on the income statement. When you pay employees for wages, that's cash going out of the company to the employees' personal pockets, and that ends up being salaries and wages expense, which is on the income statement. Again, needing to pay for taxes, usually income tax expense is what comes to mind here, and that's an income statement item. If you have to pay interest on any loans, remember the interest on a loan is an expense, interest expense. And so, believe it or not, if you're paying interest on a loan, that interest is going to be expensed. And so technically it's an operating activity because it's a income statement issue. And all the other expenses, whether it be rent or so forth, end up usually on the income statement. So all of these activities represent operating activities. Cash coming in from operating, cash going out from operating. Like I said, investing activities, we are looking for changes. I think the most important thing is to look at the asset section, okay? Because even if you did have a long-term investment, that would be an asset, and certainly property, plant, and equipment are long-term assets as well. So investing activities really have to do with certain asset accounts. And of course, again, you can cash going in and cash going out of the company is the only two ways we look at cash flow. So how would cash come in? Well, if you sold off any property, plant, and equipment, you would be getting cash for that sale. So that would be cash coming in. Certainly too, if you sold off any investments and you collected cash for that, that would be a cash inflow. Also, if you had any other types of investments like loans that you are collecting, that would be also technically an investing activity. I look at the cash outflow. Is the company purchasing more property, plant, and equipment? Because this is really where you can see a company dedicated to growing. More locations, more sales, more customers, etc. And when I talk about growth, I'm really talking about in terms of revenue. And everything starts with revenue. Revenue is critically important. So this leads to higher revenue. If you have more stores, you're going to have more revenue. You can also purchase investments. Certainly, you need to pay for those. So that's cash going out to pay for either a debt or an equity investment of any sorts. If you make loans to other businesses or whatnot, that's going to end up being collected with interest. The loan itself is an outflow. Financing activities, again, where do you get the money, right? Where do companies get money to buy things? That's the financing piece. So here we're looking at long-term liabilities and stockholders' equity. And again, in the cash flow statement, We're only looking at two things happening, cash coming in or cash going out. So cash comes in every time they sell common stock, they sell shares of common stock, what's coming in, cash is coming in. If they issue bonds or debt, what's happening there, cash is coming in, right? That's they're borrowing money, so cash is coming in. So inflow, sale of common stock or a sale of debt would bring cash into the company. A cash outflow, again, would be related to long-term investment, stock holds equity. So when you pay back debt, that's cash outflow because you're paying back debt. When you pay dividends to stockholders, that's cash going out. Most dividends are paid in cash, so that's cash going out of the company. So this is how we would look at things. Okay. Just to know too that there are significant events that don't require any cash. We call them a non-cash activity, significant non-cash activity. So you can buy assets either by issuing common stock or by issuing debt. So you can buy assets, you don't have to buy assets with cash all the time. Some companies will buy assets with common stock, some companies will buy assets by issuing debt. That's a non-cash activity. You will see more assets, but you will not see any cash moving. Okay. Another thing is when bonds are converted into common stock. There are convertible bonds. Normally speaking, a bond has to be paid back in cash, but a convertible bond can be paid back with shares of common stock. So if we do have certain bondholders that convert their bond to common stock, we're simply paying them in shares of stock. We're not paying them in cash. That's a non-cash activity, but it's significant because we don't have that debt to pay anymore. We paid it in shares of stock. And any exchanges of plant assets, right? So if we if we exchanged our truck for a new truck, and no cash went with that exchange is also a non-cash activity. So because these are significant, they need to be reported. So companies will report these usually in a separate schedule at the bottom of the cash flow statement. Some companies will simply put these as a separate note into the financial statements when they do that. But they must report them either way because they're significant. They're significant. Okay. One thing you're going to know about, particularly when we get to learning objective 2, is the difference between a company that shows net income and a company that has net cash that's provided by operating activities. You say, well, hang on a second. Net income is revenue minus expenses. Okay. And operating activities are mostly income statement accounts. So they're also kind of related to revenue and expenses. How can they be different? The difference is when you calculate net income, you're using the accrual basis under generally accepted accounting principles. So the income statement is created with an accrual basis accounting. When you do a cash flow statement, you're using the cash basis. Okay. And what the cash basis is only counts when cash is moving in or out of the company. And that's what you're going to see is a significant difference when we get to learning objective 2. So Kohl's, for whatever year this is, had $889 million of net income, but they had $1.8 billion in cash provided by the operating activities. How can that be? You're going to see. Walmart had $16.6 billion in a profit for whatever year this was, but yet they had over $25.5 billion in cash provided by operating activities. How could that be? You will see. Okay, learning objective 2. When we actually create the cash flow statement, we are going to use the indirect method, but there's actually two methods that can be used in order to present what happened to the operating activities of the company. But in general, all cash flow statements start with operating activities, then investing activities, then financing activities, and then they will tell you the difference in what happened to the cash. Okay. So that's basically all the cash flow would tell you. And this is a perfect example of a statement here. As I said here, the very first part, you'll see the cash flow from the operating activities. All the operating activities will be listed here. Normally, operating activities provide money, provide cash. In other words, again, either cash flows in or out. For operating activities, you're going to see cash flowing in. Okay. The word used here in parentheses simply is cash going. If cash went out, it would be used. If more cash went out than in. More cash in, provided. More cash out, used. For operating activities, you're going to see provide a lot. This is often going to be a positive figure. Okay. Cash flows from investing activities. Now, investing activities, again, you want to see a company buy property, plant, and equipment. You want to see them being committed to growing. So when it comes to the second part of the cash flow statement, seeing those investing activities, you're probably going to see a lot more money being used, or cash going out to buy all those fixed assets. And so very often you will see the net cash will be used by investing activities. Now, even though these are in parentheses, there's no positive and negative in a cash flow statement. It's simply cash coming in or cash flowing out. It's either in or out. That's basically it. The third part of the cash flow statement focuses on financing activities. So you'll have a list of the financing activities. Again, anything to do with long-term liabilities or stockholders' equity we listed here. This can go either way. Sometimes there's more cash coming in, so there'll be cash provided by financing activities. Sometimes there'll be cash going out, so there'll be cash used. This can go either way. In essence, the total of these three numbers, meaning the cash, usually cash provided by operating activities, cash used by investing, and whatever's happening with finance activity, gives you what we call the net increase or decrease in cash. This number is going to tell you how much cash either increased or decreased during that year, whatever the period is. When you take that increase or decrease, it should be the difference between the beginning cash you have at the beginning and the ending cash. So whatever happened here, the difference for cash is going to show up as the beginning and ending. And that's basically a cash flow statement. Again, on occasion, you will have those non-cash activities listed on the cash flow statement. Sometimes it's in a note, but in many cases, it'll be listed here. But because this does not have to do with cash, this is going to be one of the more interesting points here. Okay. Of course, where does this cash come from? You'll see this on the balance sheet. See this on the balance sheet. The cash flow statement only covers cash. So whatever the balance sheet said the cash was at the beginning, and at the balance sheet says the cash was at the end of a period, you'll be able to explain that based on all these activities. Okay. So basically that is the end of learning objective 1. Identifying the cash flow activity is very, very important. This should be the first thing you look at seriously. Okay. So how would you classify these transactions? Again, look at the account that's being affected. So here, they issued shares of common stock. So when you issue, you sell. Right? They issued shares of common stock for $800,000 of cash. This cash is coming in because they issued shares. Common stock is stockholders' equity account. So this is going to be a financing activity, okay, because it affects common stock. Cash is coming in from selling common stock, financing activity. Here they borrow $200,000 from a bank, signing a 5-year note. So this is borrowing money. A 5-year note's a long-term liability. So this is also going to be a financing activity. Here they purchase 2 semi-trailer trucks. Now a semi-trailer truck is an asset, and you're going to use this asset for a long period of time. So you paid $170,000 cash for these 2. So what type of activity is this? This is an investing activity because this is property, plant, and equipment, right, that you're buying. You paid employees $12,000. Well, when you pay employees $12,000, you know it's going to be a salaries and wages expense. That's an operating activity. And when you collect cash from customers by providing them services, that's revenue. Revenue is also an operating activity. Okay, quick break, come back to our group, ask if there's any questions on that in general. Does that go okay? So objective 1, making sure you can differentiate between operating activities, investing activities, and financing activities, and how to be able to identify that. So it's going to be your first set of homework. We good? All right. So let me jump back in, and we're going to do learning objective 2, and that's all for today. Learning objective 2 is really about preparing the cash flow statement. We're going to prepare it using something called an indirect method. Okay, there's the direct method, there's the indirect method. The indirect method is significantly more popular because it's easy to do. In order to prepare a cash flow statement, you're going to need 3 sources of information. The first thing you're going to need are comparative balance sheets, so the balance sheets from last year and this year. You are also going to need a current income statement. And then you're going to need any additional information regarding anything that happened to your assets, liabilities, or equity. Okay, that's the additional information piece. There are 3 things that you have to do, and the first step is the most difficult one. So you're going to spend mostly all of your time on step 1 here. And that's because you have to convert, okay, your net income from an accrual basis, which is how we set up those financial statements. That's what GAAP requires, to a cash basis, which you haven't done before. So that's what's going to, it's not difficult, it's just different. So that's just how we determine the net cash provided by operating activities. That's why the net cash provided by operating activities is going to be different than net income, because when we convert from an accrual to a cash basis, you'll see what happens. So that's the first step. That's going to be the first major step. The second step, much easier in terms of it's a lot more obvious. You're going to look at changes in asset and liability accounts regarding investing and financing activities. You're also going to make sure you know what your non-cash transactions are. But again, that should be a lot more obvious. And the third step should be able to explain the difference in the cash from year 1 to year 2, because the cash flow statement will be able to identify that difference. Okay. So again, the first step is going to be the most difficult step to do. First of all, we do the indirect method. I'm not teaching the direct method. The indirect method is definitely much less costly for companies to prepare, and it's also easier. And the indirect method tells the story much better on why there's a difference between net income and net cash provided by operating activities. And that's an important story to know. So again, here's our, we need documents, right? So here's our income statement. for that particular year. Notice this particular company had a profit of $145,000. We need comparative balance sheets. Comparative balance sheets are back-to-back years, right? And we look at the changes. We look at the changes from 2016 to 2017. Okay, so that's really, I know people are, I read left to right, yes. For a comparative balance sheet, when you note the differences, you're noting from the base year to the most current year. So you're actually reading the opposite. So notice here that cash went from 33,000 as a balance in 2016 to 55,000 in a balance of 2017. That $22,000 increase is going to be explained on the cash flow statement. Okay. You also have to note all the other accounts and their differences. So when you look at an increase or decrease, again, you're going from 2016 to 2017. Notice that accounts receivable went from 30 to 20. So it actually decreased by 10,000. However, inventory went from 10 to 15. So that increased by 5,000. So you're going to be doing this all the way down through all the accounts. Okay. These are just your asset accounts. So we also have to do it for your liability and equity accounts. So here are the liability accounts and the equity accounts for 2017 and 2016. Again, you're noting the difference from the base year to the most recent year and what the difference is here. Again, when you go from 12,000 in payables to 28,000 in payables, that's a $16,000 increase. When you go from 8,000 in income tax payable to 6,000, that was a $2,000 decrease. And you do that all the way through. Okay. And then here's just all this other wonderful additional information that we have to know about as well. And let's look at each individual piece. First thing is depreciation expense is $6,000 for building, $3,000 for equipment. Now you're going to find out why that's important in a moment. The company sold equipment. It had a book value of $7,000. That's nice, but they got $4,000 cash for that equipment. And since the cash flow statement follows cash, that's what you want to watch. They issued $110,000 of bonds in a direct exchange for land. That's significant, right? Because they bought a large chunk of land with no cash. They issued bonds in direct exchange for the land. Here they purchased a building for cash, a $120,000 building for cash. They bought $25,000 of equipment for cash. So again, because they used cash, that's going to show up. They issued common stock for $20,000 cash. So again, when you issue, you're selling shares of common stock, the company is receiving $20,000 in cash. And the company declared and paid a dividend, cash dividend. So this is cash dividend. It's going to impact cash. So all this information is really critical to remember. So step one here is that converting. Okay, we're going to need to convert here. We're going to convert from the accrual basis, which is what the income statement was calculated with, to a cash basis. So we're basically undoing a few things to get the cash basis. The first thing we're going to be doing is we're going to add back something called a non-cash expense. And overwhelmingly, all we're really talking about here is depreciation. When you think about all the expenses that you're aware of, you write a check for rent expense, you write a check for salaries or wages expense, right? You're writing, it costs cash for all these expenses. Depreciation expense doesn't cost any cash. You're not writing a check to anybody. You already bought the asset some time ago and you're in the process of depreciating it. So this is called a non-cash expense. Well, if it's a non-cash expense, on the cash basis, it never happened. That cash never went out. So that's important to know. The second thing we do is look at any gains and losses. You probably remember way back in financial accounting, we had to do a multi-step income statement. And part of that multi-step income statement had a section that we called other revenue and gains, other expenses and losses, that sort of other category. Well, anytime we sold off an asset and we took a loss on it, we had to declare a loss on the disposal of assets. Anytime we sold an asset and we had a gain, we had to declare a gain. Okay. So what happened to those gains and losses? We added them to the income statement. That's how we had to do it under the accrual basis. We simply have to reverse all of that out on the cash basis. Okay. And the last thing we're going to be doing that's going to take a little bit of time is analyzing the changes in current assets and liabilities to really kind of analyze, did this mean cash went out or cash stayed in? And you're going to get that analysis in a moment. So first things first, okay? The first thing we do in understanding how to get the cash flow from operating activities is the starting point is your net income. So you're going to put your net income right from your income statement down on the paper. That's the starting point. These adjustments come next. The first thing we're going to do is add back depreciation expense. We're adding it back because it didn't cost us any cash. So for a cash flow statement, this is cash staying in the company. All right, so we add it back into the net income because it was subtracted out. Well, yes, under the accrual system, that's correct. Under the cash system, no cash went out. We're adding it back. Okay, so we're adding back depreciation expense. The second thing we're doing is we're reversing any losses or gains that we had to declare on our income statement under the accrual system. Okay. And so basically, remember, a loss or a gain on the disposal of equipment is based on the book value of the equipment. And so this is where the accrual system says that everything has to get counted. The cash basis, nothing happened here. So it's not supposed to be part of the original statement. So anything that we have to do is reversed. If we had a loss, we subtracted it on the original income statement. We're adding it back on the cash flow statement. If it's a gain, we added it to the income statement when we did it. So we're going to subtract it out of the cash flow statement. So it's simply reversing any gains and losses from the original income statement. Remember, this loss is already calculated here. I'm going to put it back. If it was a gain, it would be calculated here. We're going to take it out. That's all we're doing here. That's the reversal. Here's where it gets fun. What are the changes to certain current assets and current liabilities? So check this out. Accounts receivable, you started the year with 30,000 of receivable. Remember, receivable, you're waiting to receive cash. Right? You ended the year with 20,000. So in other words, in order to get from 30,000 to 20,000, you have to collect more cash, right? So if accounts receivable goes down, we're assuming your cash went up. And so we add in the additional cash you collected from accounts receivable. Okay. As I told you, this is where it's going to get a little interesting. But you're going to think about it from a cash perspective. And you're looking at those changes. Less receivable means more cash came in. That's all this is saying. That's why we're adding the cash back in, because technically more cash came in. Inventory. Well, you started with $10,000 of inventory. You ended with 15,000. How do you get from 10,000 to 15,000? You have to spend 5,000 more. So if you bought more inventory, you used more cash. If you've used cash, we take it out. So any increase in inventory means we have to use cash to do it. Remember, the parentheses here doesn't necessarily mean a negative. It simply means cash going out. Okay, cash out. So any increase in inventory meant we have to use cash for it. So the use of cash is in parentheses. Prepaid expenses, again, prepaid insurance, supplies, etc. If you have more supplies, you have to use cash for that. If you have more prepaid insurance, you have to use cash for that. If you have less, you saved cash. So that's how the cash basis sees things. So in this case here, when prepaid expenses are gone up, you're assuming you have to use cash. If you used cash, it's a use. Take it out. And so in this case here, we had an increase in prepaid expenses. So we have more supplies or more prepaid insurance. If you have more of that, you have to use cash. So we take this cash, this is cash going out. Okay. Looking at our liabilities, accounts payable is money we owe for other bills that we have, right? So if your accounts payable goes up, it actually means you saved cash, right? If you owe more cash next month than you do now, well, you're saving cash now. Cash is staying in. That's how they look at it. Okay. Same thing with, the opposite is true with income tax. Income tax went down. The only way a debt goes down is to use cash. So income tax payable goes down because cash went down. Accounts payable went up because you saved that cash from going out. So as interesting as that might be, that's exactly how they look at it from a cash perspective. Accounts payable, an increase in accounts payable is the same as cash staying in the business right now. If you've paid down your income tax payable or any other payable, that means you use cash being used. So look what happened. We went from net income on an income statement using the accrual basis of $145,000 to basically undoing all of those accruals to a cash basis. And now we have the answer. What is the net cash provided by operating activities? $172,000. That's how they differ. Okay, we're taking the income statement apart and converting it to a cash basis. That's going to be your most difficult part of this. If this made some sense to you, you're ahead of the game. This is a very good illustration I highly recommend you use when you're doing this, because I think it explains things pretty well. Depreciation expense is added in. Gains and losses are reversed out. So a loss was subtracted on your income statement to get net income, add it back in. A gain was added to your net income, take it back out. Just reversing those. And any changes for current assets and current liabilities are based on whether it used cash or not. Okay. So, that's basically it. So increases in current assets means you have to use cash to buy more inventory. So you deduct it. However, if a decrease in a current asset meant you saved cash in. Increasing a current liability means you saved cash in, add in. Paying down a current liability means you use cash, take it out. So that's your conversion table for the indirect method. I highly recommend you use that illustration. I think things will make a lot more sense. Step 2 is identifying those investing and financing activities. It's significantly easier to identify these things because there's no conversion to do. It's stated. We have more land. Why do we have more land? We have more bonds. Okay. So in this case, this is a non-cash activity that affected land, which is an investing activity, and bonds payable, which is a financing activity. Okay. So this would be put on a separate schedule to show why we have more land and why we have more bonds payable. Another thing that we would show are any of the other investing activities that happen. Remember, you might have remembered part of the information was we used cash to buy a building. We used cash to buy equipment. Remember, the parentheses simply means a use of cash, cash flowing out. Cash had to flow out to buy the building, had to flow out to buy the equipment. That's why these are listed in this way. We sold that used equipment. We got $4,000 for it. Well, again, the sale of equipment brought in $4,000 cash. It's a positive number only because it represents cash coming in. When you add the differences between cash going out and cash going in, you'll see there's more cash going out. That's why they use the word used. Remember, if cash is coming in, cash is provided. Here, when cash is going out, cash is used. Okay. You'll see that, again, the building account increased because we used cash. The equipment account increased because we used cash. We also sold equipment for cash. We don't really care much about the loss. We're following the cash on the cash flow statement. Okay. So that explains the investing. Remember, the loss on the equipment is reversed in the operating activity thing that we just did. The sale of the equipment is cash coming in. So they're all here. They're all accounted for, just in different sections. So again, cash used means cash flow out. Cash provided, cash flowing in. The last section is financing activities. Two things happen here. We had more common stock because we sold common stock for cash. So the issuance of common stock brought in $20,000 of cash. Cash flowing in is why it's looking like a positive number. And we paid our dividends to stockholders, and that was cash going out of retained earnings. Of course, your net income in retained earnings is from the income statement prior. So what you see is your net income is up here. That's how we started. But your payment of cash dividends looks like cash is going out. So again, here we only had two things happening with financing activities, and we used more cash than we got in. So net cash used was $9,000. $172,000 compared with the 141 out and 9 out gives you a difference of $22,000. That's exactly what we saw early on. The change in the balance sheet from 2016 to 2017 for cash was a $22,000 change. Now we can understand exactly where that came from. The beginning of the cash period, which was the 2016 balance, was 33. It changed by 22,000. So the cash at the end of the period is 55. This particular 55,000 is what you see on the balance sheet for this particular year. And that basically explains this increase in cash from 33 to 55. $22,000 difference is now explained in the cash flow statement. Does that work okay? Did I pull the story together okay? Questions?